The market is currently closed, and as of the final bell on July 7, 2026 at 4 p.m. Eastern Time, Nuburu Inc., trading under the ticker symbol BURU on the NYSE American, closed at exactly $0.13 per share, marking a tough session with an intraday drop of over 4% on substantial daily trading volume. While a sub-dollar micro-cap stock plunging deeper into penny stock territory usually signals a quiet, agonizing exit from public markets, the underlying reality for Nuburu presents a completely unexpected structural twist that most short sellers are entirely missing. While retail traders skimming through basic scanning tools on popular investing sites see a business fighting for its life against delisting notices, a massive capital overhaul has quietly reset the company's internal net worth from a massive negative deficit to a positive asset base practically overnight. Investors who treat penny stocks with the same casual approach they use when placing a speculative tech trade on a Robinhood app are overlooking a high-stakes balance sheet restructuring that could either completely wipe out equity holders or trigger one of the most explosive operational recoveries in the defense sector this year. This expectation of immediate failure versus the hidden reality of a sweeping corporate rebuild creates a massive point of friction that demands a closer look. When most people look for a viable online investment opportunity, they naturally flock to well-known options like Tesla stock, Apple stock, or Nvidia stock because massive, liquid companies offer a predictable landscape with clear visibility. If you manage your long-term assets through an automated platform like Schwab Intelligent Portfolios or seek out structured guidance through professional investment help, microcap defense operators like Nuburu rarely appear on your radar. The general consensus among retail participants engaging in self-investing or looking for the next breakout on retail online investing websites is that Nuburu is a struggling high-tech laser business running out of gas. The narrative seems solid on the surface because the company has spent years racking up massive net losses and burning through capital while trying to commercialize blue laser hardware solutions. But the contrarian take that forces a complete rethink of this entire setup is that Nuburu is no longer just a hardware manufacturer trying to sell expensive industrial machinery to unproven commercial clients. Management has effectively abandoned its old standalone hardware approach, executing a comprehensive transformation plan designed to rebuild the entire entity into an integrated defense and security platform. This shift combines specialized laser hardware with critical software, autonomous systems, and defense mobility programs. To understand the recent daily swings and intense trading volume fluctuations that have characterized Nuburu stock over the past few weeks, we need to examine how institutional positioning and recent regulatory filings are clashing with market expectations. For a long time, the shadow of an NYSE American continued listing deficiency notice hung heavily over the company, driven by the fact that their stockholders' equity had fallen deep into a negative deficit of over $15 million by the end of last year. When a company is facing an active delisting threat, institutional capital flees, short selling intensifies, and volume spikes as speculative traders shuffle positions on platforms like the Interactive Brokers platform or check real-time technical indicators via a Fidelity trading platform. However, the preliminary numbers from May and the audited figures from the first quarter show a massive swing. Stockholders' equity jumped by over $17 million, pushing the company back into a positive equity position of over $2 million, with management recently issuing an explicit letter to shareholders stating they expect to materially exceed the $4 million threshold required by compliance standards. This massive capital restructuring was not achieved by simple cost-cutting or organic cash flow, but through a highly complex series of balance sheet adjustments, including a significant reverse stock split of 1-for-4.99 executed earlier this year and the conversion of heavy preferred stock obligations into common shares. When retail investors managing an individual brokerage account see a reverse split and heavy share conversion, the immediate expectation is severe dilution and downward pressure on the stock price, which explains why the shares have faced a steep decline over the past 12 months. But the reality is that by wiping out over $8 million of preferred obligations tied to previous transactions and reducing other liabilities, the company has cleared out a toxic capital structure that was actively preventing institutional investment. If you look at high-volume platforms like Interactive Brokers stock trading or track active order flows on the Robinhood stock trading system, you can see that the massive trading volumes, sometimes exceeding 40 million shares in a single session, reflect an intense tug-of-war between old trapped capital exiting the stock and new speculative accounts betting on this balance sheet cleanup. Comment below how many shares of Nuburu you currently hold, or if you think small defense tech contractors can successfully compete against massive Tier 1 military suppliers. The macroeconomic backdrop adds another layer of pressure as rising capital costs make it incredibly expensive for microcap firms to secure traditional bank financing. This has forced Nuburu to rely on structured equity-linked solutions and unsecured debentures, such as their recent agreement to secure over $23 million through a securities purchase agreement, which carries an 8% annual interest rate. While this financing keeps the lights on and funds their active defense acquisitions, it highlights the heavy reliance on complex financial instruments that can increase the outstanding share count and dilute existing owners over time. Investors managing their retirement capital through Fidelity IRAs or tracking defensive assets via Fidelity mutual funds typically avoid this level of volatility, but for those engaged in active online investment strategies, the structural changes at Nuburu provide an instructive look at how distressed tech firms try to survive. Let us shift focus to what this business actually does and how its core model has transformed. Historically, Nuburu built its reputation for manufacturing high-power blue lasers, which offered distinct physical advantages over traditional infrared lasers when welding highly reflective metals like copper, stainless steel, and aluminum. This technology is valuable for applications like electric vehicle battery manufacturing, aerospace components, and advanced consumer electronics. However, the commercial market adopted this technology much slower than anticipated, leading to low revenue and massive losses, including a staggering $16 million net loss in the first quarter of last year. In response, the company pivoted towards a dual-use defense and security model by acquiring and consolidating entities like Liacon and Orbit, while advancing major partnerships with global defense firms like Tekne in Italy. Instead of just selling lasers to industrial factories, they're integrating their technology into non-kinetic weapon systems, electronic warfare setups, directed energy applications, and mobile additive manufacturing systems designed for active military conflict zones. The financial results from their recent quarterly report demonstrate the early effects of this transition. Revenue for the first quarter reached just $400,000, which seems modest until you realize the company had zero revenue in the same period a year ago. More importantly, the massive quarterly net loss was trimmed down from $16 million to less than $500,000, largely aided by non-operating fair value gains on warrants and debt instruments. This shows that while the operational engine is starting to turn, the company still faces an uphill battle to achieve true self-sustaining profitability. If you analyze these numbers on sophisticated software like the Interactive Brokers trading system, or compare them against broader indices on popular investing sites, it becomes clear that the stock is priced purely on its future survival rather than its historical track record. A casual glance at any individual brokerage display would suggest a dying enterprise, but the deeper look reveals a business model that has fundamentally altered its target audience from price-sensitive commercial manufacturers to high-budget national defense agencies. Looking forward, the future outlook for Nuburu depends entirely on a few critical upcoming catalysts and severe underlying risks. The primary catalyst on the immediate horizon is the formal conclusion of the Italian government's Golden Power review regarding Nuburu's 70% majority acquisition of Tekne, an aerospace and defense electronics firm. This regulatory review is expected to wrap up in the first week of August, and securing approval is absolutely critical for the company's scaling strategy. Furthermore, the commercial pipeline looks active, with over $6 million in unearned commercial opportunities across their software and directed energy verticals, including a $2.2 million Blue Laser rover opportunity being developed through Lyacon. If these pipeline opportunities convert into recognized revenue, the reality will completely shatter the low expectations currently reflected in the 13-cent stock price. Conversely, if regulatory hurdles delay the Tekne deal, or if the company fails to maintain its positive equity compliance plan by the October deadline set by the exchange, delisting proceedings could resume, which would devastate liquidity and severely hurt investors using mainstream platforms like SoFi Active Investing or Robinhood Investments. The ultimate lesson of the Nuburu story comes down to how sharply the market's expectation contrasts